Hello, my name is Joe Hopkins, Hopkins CPA firm. Do work in probably 30, 35 different states across the United States. We do a lot of tax resolution for large IRS debts in the past, tax preparation for individuals and corporations, and also tax planning for high net worth individuals and other corporations, partnerships, and S corporations as well. Today, I wanted to talk about the Schedule L as it is on the corporate tax returns, the what we refer to as the C-Corp return, which is the Form 1120 tax return, or the S corporation, the 1120S, and you also find this on the partnership tax return, referred to as the Form 1065. I want you to take a moment. I want you to stop this video and go get your tax returns from the previous 2 years that have been filed. You know, whether that's 20 and 21, 21 and 22, whatever. Stop the tax return now. Go get those tax returns, and I want you to find Schedule L if you have a C corporation, S corporation, or a partnership, and go find that right now. Okay, you're back. Now, on the Schedule L, this is the balance sheet information that is required reporting on some of the tax returns. If you have it's not always required, but generally if you have over $250,000 of gross income, this is generally a requirement. Sometimes you'll find this prepared by tax preparers, even if it's under $250,000. But what I wanted you to focus on today is put them side by side and look at the several different things on here. First, look at your cash balance. Does it look, if it's in the ballpark? I mean, is that what you normally carry? You're going to see a beginning of the year balance and you're going to see an end of the year balance. Does it look kind of in the ballpark? Scan on down. The reason why I asked this is I ran across a tax return the other day that was prepared by another tax preparer, and it was just shambles. This person should not be doing tax preparation. So it had a negative $1 million on the tax return and as a beginning balance, and the ending balance was like $57,000, right, for the tax year 2021 as an example. Well, so in theory, the ending balance for 2021 on cash balance should be the carry forward balance for the year 2022 beginning balance, right? Wrong. It still had the same negative $1 million carrying forward as the same beginning balance for the year 2022. So just kind of, I know you're not an accountant, I know you're not preparing taxes, but just kind of think of it logically, right? Beginning of year balances, you have transactions, you have end of year balances, right? That's the point in time. Those beginning year balances need to carry forward on your tax return to the beginning year for the following year. So the end of year for the previous year carries forward to the beginning year of the next year. Make sense? Right. That's why it's important to keep your tax balances and cut off your general ledger and QuickBooks and make that closing date entry so that it doesn't mess up your tax preparer as well too. Now look on down your schedule. Do you see any other anomalies? Do you see any negatives on there? You should have all positives, right? Another thing to look forward that I saw in this prior tax return, they had assets that were depreciated more than the amount of assets that they had on the books. They had like $150,000 extra depreciation above and beyond the asset carrying balance. Just to scan for any anomalies that you look forward to. Also, this is accounting 101. You may not have learned it. I know you're a good businessman out there and you may not know this, but any accounting 101 class, assets equals the liabilities plus equity. Okay, that's the basic formula of 101. Always your assets must equal the total of your liabilities plus equity. Let me give you an example. If I own my house, say it's $250,000, right? And I have a mortgage on it for $100,000. Okay, I have an asset of $250,000. I have a mortgage of $100,000. That means I have $150,000 equity, right? So equity $150,000, liability $100,000, asset equals $250,000. Assets equals liabilities plus equities. The same thing applies to everything in your business. I've been a CFO for several decades, so I know I've seen it all, but go through that Schedule L and see, go down to your asset line and then look and see if it equals your liabilities plus equity line. If it doesn't, you need to be questioning your CPA or your tax preparer or enrolled agent or other tax professional. Anyway, that's it for today. Please like and subscribe to our channel. And if you have any questions, just put a comment in the comment box and we'll try to answer those questions on the fly as we move forward. But stay tuned for additional videos and please tell your friends. Thank you.